The FDIC, the people responsible for the safety of your deposits, just issued a dire warning. A growing number of banks are now on the brink of insolvency. But this $364 billion crisis isn't just about bad management. No, it's a chain reaction set off by one core issue: unsustainable federal debt, the consequences of which aren't coming, they're already here, and they are accelerating. Today, we'll break down how skyrocketing federal debt has flooded the system with cash, how banks' once safe assets are now ticking time bombs, and most importantly, we'll expose how this cycle doesn't end in a soft landing, but instead is hurtling towards hyperinflation and a crash landing that no one can afford to ignore. When the federal government takes on enormous debt, say $13 trillion in the last 5 years, that debt creation does not live in a vacuum. It gets monetized. Those in power will tell you, oh, these cash injections, they're going to stabilize the economy. They're going to help the everyday American. But in reality, what ends up happening is that this cash fuels speculation for Wall Street and the wealthy elites, meaning that the rich get richer while there's no real tangible growth. This is what we saw in the aftermath of 2008. But the difference with 2020 is that as Wall Street played its speculative games, banks were left holding an unprecedented amount of deposits. And while it might sound like the most normal thing in the world for a bank to be holding deposits, I'm going to let you in on something that feels like a secret. Banks are for-profit institutions. Do not ever forget, they do not work for you. They certainly don't work for me. They work for their shareholders and their private investors, which means that the less deposits a bank keeps on hand, the higher risk for you and for me in the entire financial system, but the more potential that bank has for profit. But this part will really blow your mind. Not a lot of people realize that when all of that government spending hit the system in 2020, at the exact same time, the Federal Reserve waived its reserve requirement ratio, meaning that banks no longer have to hold not even a single dollar of all of their depositor funds. So of course, they gambled with your deposits. Now, a lot of the deposits were put into what they thought were safe bets, long-term treasury bonds. After all, low interest rates and government backing made these seem like a sure thing, a win-win for banks and government. Of course, that illusion of safety only stays intact if interest rates remain low and the asset remains stable. Spoiler alert, neither happened.
Committee anticipates that ongoing increases in the target range for the federal funds rate will be appropriate.
What happens when interest rates rise is bond prices fall.
It's the 10-year and out. And that's where we're seeing all the volatility.
Fast forward to today, the FDIC reports $364 billion in unrealized losses on banks' balance sheets, primarily from bonds that they dumped your deposits into, as well as commercial real estate, something that they thought there always would be a strong demand for. Quick refresher, unrealized losses again represent the difference in what a bank paid for an asset versus the current market value of an asset. But that means that we have banks across America who have the least amount of reserves in history, combined with the fact that their assets on their balance sheets are actually liabilities. In fact, FDIC Chair himself, Martin Gruenberg, says that the bank's unrealized losses are probably closer to $500 billion. So we don't even know the full extent of just how bad it is. What do you think? Do you think it's worse than what they're telling us? Let me know your thoughts in the comments below. Because if you ask me, these assets are a ticking time bomb, and the only reason they haven't gone off is because banks haven't been forced to sell yet. But liquidity pressures are mounting. The more these assets fall in value, the harder it is for banks to meet their obligation. All of these banks were just waiting for rates to go back to zero, which is not happening anytime soon. They were waiting for demand to skyrocket again for commercial real estate, hoping if they put it off long enough, everything would be okay, which is not happening. FDIC Chair Gruenberg said last week, the industry still faces significant downside risks from the continued effects of inflation, volatility in market interest rates, and geopolitical uncertainty. But these people make me sick using all of these words and not even getting to the root cause of what's really going on. Continued inflation, scratch that. It should be $36 trillion in national debt. Volatility in market interest rates, scratch that. More debt equals more inflation equals rates higher for longer. Geopolitical uncertainty, scratch that. Weaponization of the dollar. Inflation brought on by government spending is not and was never transitory. Our government continues to overspend, which means that inflation continues to grow well above the Fed's 2% target rate. But what does that mean for banks? Well, the FDIC chair finishes by saying these issues could cause credit quality, earnings, and liquidity challenges for the industry. But what is he actually saying? Well, credit quality means loan defaults, earnings means no profit bonds, and liquidity challenges means banks cannot sell their assets without exposing massive hidden losses. But that's the catch, that last part. That's the reason that the banking industry hasn't collapsed all around us yet. It's because they have not been forced to sell yet. I've used this analogy before, but imagine you buy a house for $700,000 and a couple of years later, well, it's worth $500,000, but you're still living in that house. You haven't sold it. Well, you technically on paper have not lost that $200,000, but if you were forced to sell tomorrow, you would take a substantial loss on your investment of your house. Now imagine that scenario, but on a massive $500 billion scale. This is what's happening with banks. But pressure is mounting. If a bank doesn't have enough cash or sellable securities, then they are forced to sell those assets at a loss, especially should there be a situation where depositors start withdrawing and they do not have enough to cover the withdrawals. I mean, we saw this happen with Silicon Valley Bank, and the collapse was almost overnight. And if enough banks start failing, what happens next? One of the biggest lies we've been sold is that the Federal Deposit Insurance Corporation, the FDIC, has enough funds to cover our deposits should anything happen, when in reality, the FDIC has less than 2% of all total insured deposits in their deposit insurance fund. So what then? The government steps in? I don't have to tell you that they don't have anything set aside for bank bailouts. So what happens next? They print more cash. More cash means more inflation. And if you're saying, so what, who cares? It won't really impact me. No, this time will be different because government debt is already at a max and inflation is already dangerously high, meaning that this will not be a repeat of 2008. No, this time will be different and it will be much worse. Hyperinflation is not just an economic term, but a devastating reality, one where your savings, the dollars in your wallet, your retirement, everything you own is worth less at such a rapid rate that you can't even spend it fast enough as it's losing its value. During this period of time, the basic necessities of life become unaffordable and most people will be left with nothing, leading to societal unrest, chaos, and who knows what else. But what happens when banks themselves can't even survive the hyperinflation storm? This is where bank bail-ins come into play. Unlike bailouts, where our taxpayer money was used in 2008 to bail out greedy banks, a bail-in is where banks are legally allowed to seize your deposits to make themselves whole again.
It's important that people understand they can be bailed in. They're going to be.
But I don't think you have much hope of reaching a public that doesn't have a professional need to know.
Your hard-earned cash is used to keep the financial system and institutions afloat that they ruined in the first place. And since depositors are technically unsecured creditors, well, that means that your deposits are at risk the second that confidence cracks. But even bail-ins cannot stop the inevitable. When a currency collapses and hyperinflation spirals out of control, there is only one solution in a currency's life cycle, one moment that you are leading towards that is inevitable, and that is a currency reset. A currency reset is the death of the dollar as we know it today, but it could look different depending on what they decide to do. The dollar could suddenly be valued and pegged to gold, or it could be a new digital currency that's issued. Maybe it's some combination of factors, even a reevaluation of the currency, which essentially is just lopping off zeros. Imagine that tomorrow they decree that the dollar is suddenly worth 1/10 what it was the day before. So you had $100,000 US in your bank account. Well, suddenly now you wake up, it's only worth 10,000. These are all real scenarios that have happened before, and all of the warning signs from history are there that this is the outcome we are catapulting towards. The question is, will you be prepared when the reset happens? Do you want to wait and find out, or take action now? A currency reset is a process until one day it's an event. Every single day we are in that process as your dollar is worth less and less, which is why I personally sleep well at night knowing I am protected outside of the system, outside of the dollar, and I am ready so that as that process accelerates and when that event happens, I don't have to be concerned. This is because I have my strategy in place. If you are concerned or you don't have a strategy, that is what our team does. They study currency life cycles and help people prosper during times of downturn. If you want to learn how we can help you, what we can do for you, call us at the number below or click the Calendly link in the description. Do it now while you're thinking about it. Do not wait, because I can only speak for myself, but I can promise you it feels good to wake up every day and go to bed every night knowing that you are protected. And in the meantime, as always, I so appreciate you being here. I'm Taylor Kenny with ITM Trading, your trusted source for all things gold, silver, and lifelong wealth protection. Until next time.